last year this time you were saying that we should be expecting to see the rate of growth reduce, but that growth would remain substantial in real terms. At the headline level, we've seen a drop. At a revenue level, that growth has been pretty tame compared to what we've been used to, certainly out of AdvTech. To what extent was the year tougher than had been anticipated from your side?
Well, I think it was a little disappointing. We weren't able to fully match the growth in overall costs in the group of 9% with revenue growth, which, as you pointed out, was limited to 7%. And that small difference is what translated into the 7% drop in earnings.
Let's take a look at that expenditure side of things, because as you say, expenditure up 9%. Where exactly have you been spending?
The two big areas that increased perhaps more than one would expect, what we call occupancy costs, which is really the total cost of occupation of rented and owned premises. It includes rent, obviously, primarily, but also rates and other similar costs. That was up 23% year on year. And we also experienced a significant increase in depreciation. Now, these two items are the result of the bringing into use of capital expenditure projects, mainly infrastructure and resources for education, projects that were approved some years ago, and the rollout took place in this year, and naturally we bear the costs as they become commissioned.
Yeah. Falling within that spectrum of capital expenditure costs, opening of Little Falls, a school west of Johannesburg in 2012, does that fall within that ambit there?
No, not at all. Those capital costs will be borne during this year and going forward. The full project will take quite a number of years to complete, and that increase in costs as appropriate will be borne once the school is commissioned. The first intake of students is expected next year.
Some would say that illustrative of the kind of demand that still is out there, but you know, where the business has almost been attributed with defensive characteristics, with the focus specifically on education, is that a characteristic that still holds, or are you seeing that whittled away at a bit? Because you know, while the private school model may be attractive, when it comes down to it, some people can't afford it as much as they could in the past.
Alicia, I think absolutely not the case. The resilience of our model has been demonstrated convincingly, we think, in this tough economic time. If you unpack the results a little, we generated a very strong cash flow. Cash conversion of earnings was almost 150%. We continued to be reasonably profitable, to deliver an increase, a small increase in the total distributions to shareholders. And we've been able to remain absolutely true to our long-term strategy of continued investment in new resources, basically new education places. Yeah. The fact that in this period we weren't able fully to match the cost increase which took place with revenue in this period does not detract from the long-term sustainability and defensive nature of the model. In fact, to the contrary, if anything. What
about your pricing power? Have you seen any erosion of that power at all?
No, we've continued to be able to recover the education inflation, which is a little different to CPI, tending to be higher, a little higher by and large. We've continued to be able to get our price increase. People, I think, have an understanding that if you want a quality education, you've got to be prepared to pay for quality educators to deliver it.
Of course, that's just one component of your business, albeit the bigger part. The resourcing division, in the meantime, has returned to profit growth, particularly in the second half of the year. We had operating profit up 13% in that division. Costs as a result of marketing and selling have always been a pretty big burden to bear during the economic down cycle. How have you managed to bring that under control, or is this more a result of the turning of the economic tides, so to speak?
Alicia, we really had both. First of all, there was stringent and rigorous cost control applied, and as much as anything, it was about directing costs into the correct and most productive areas of our activity, and it takes a little time to do the necessary adjustments and switching, but that was accomplished excuse me, that was accomplished by and large in the first half of the year and cleared the decks for a good period of growth in the second half. We have also seen in the high demand scarce skills which we serve, particularly IT, finance and engineering, as you know, we have seen an increase in demand, and we have also been very pleased with what seems to be some pretty solid growth in market share.
That focus on a niche, niche sectors like the ones you've highlighted, is that the same rationale you're using to extend into freight and logistics, HR, and then supply chain management as well?
Indeed it is, although they remain still babies, we're still growing those divisions.
So where there had been a point, where many were asking, why hang on to staffing? It's such a low contributor to your overall business growth. Now, how do you see that shifting and contributing to the group's growth moving forward?
We've developed a strategy where we believe that the appropriate percentage of our total business for the staffing component is in the region of between 15 and 25%. We think on that basis it makes a healthy and respectable contribution with very low demands in terms of capital, and it manages itself very well. We've got a great team running that business, and we feel that that is a useful diversification of risk and a solid contributor to earnings and cash flow.